Good morning and welcome to Charting the Markets on Friday, the 6th of October. All eyes are riveted on today's US non-farm payrolls data out at 1:30 p.m. UK time. And we expect the payrolls for September to fall to 171,000, and that's down from last month's reading at 187,000. We also expect the unemployment rate to slightly slip to 3.7% versus 3.8% in August. And average hourly earnings are forecast to rise by 0.3% month on month and by 4.1% year on year. Now, that compares to 0.2% month on month in August and 4.3% year on year in August as well. At 1:30 p.m., we also have Canadian unemployment out, and there we expect unemployment to rise slightly to 5.6% from a previous reading of 5.5%. But the Canadian unemployment data will really be playing second fiddle to that of the US non-farm payrolls. Now, when you look at a study done by Reuters, it looked at the last year's volatility surrounding non-farm payrolls data and saw that on average, the declines or rises in the S&P 500 on the day when non-farm payrolls were announced were about 1.2%, and that compares to a normal day of about 0.9% intraday volatility. So we're expecting to see a pickup in volatility later on today around this non-farm payrolls data. And when we look at the FTSE 100, you can see that ahead of it, there is very little volatility. And you can see here on the daily financial bed that we have hardly been moving today in anticipation of that non-farm payrolls data. Now, any sign of weakness with regards to the payrolls could mean that the Fed may no longer have to hike its rates towards the year end, and that would then probably lead to equity markets staging a relief rally, having declined quite a lot this week and also in the previous weeks. So here, with the regard to the FTSE 100, what that would mean is that if we were to manage to rise above today's or yesterday's high at 7,489, also ideally today on a weekly chart closing basis because we are Friday, close above 7,489, then that would indicate that a reversal to the upside, at least a short-term one, is likely to take place. And that should then take us today probably to the 55-day simply moving average here at 7,520, and next week's perhaps back up towards the 200-day simply moving average at 7,650. So that is a possibility if, but only if, we were to rise and close above 7,489, that is to say yesterday's high. Now, if the non-farm payrolls number comes in higher than expected, meaning that the US labor market remains very solid and tight, then basically we could see a sell-off, and perhaps that could take us through not just this week's low, but also the early September low at 7,369. And in that case, it is possible that we may actually fall all the way back down again towards the March to August lows between 7,228 and 0.4. So the non-farm payrolls data is really important with regards to the future outlook of what the Fed is likely to do. And when we look at the S&P 500, we can see here that we have a similar situation. Yesterday, we formed this inside day on the daily bar chart, or this Harami pattern here. And we can see that we actually managed to hold above the 200-day simply moving average at 4,222, which together with the highs seen back in early and mid-May, going down to 4,187, offers us a pretty solid support area from which we have bounced back this week. So it'll be interesting to see whether after the non-farm payrolls data, we can actually rise above this inside day that we saw, or Harami pattern yesterday. And if we can rise above 4,269, that would then mean that there's a pretty high probability that we will be heading back up again towards this key resistance area now, made up of the late June, August lows and also the late September high between 4,328 and 4,337. So that is a pretty good resistance area. Actually goes all the way back up again to the mid-July low at 4,378. So I don't expect that to be overcome anytime soon, but it is possible that we could be heading into that resistance area if the non-farm payrolls data comes in lower than expected. Now, if it comes in higher than expected, it's likely that we'll retest the 200-day simply moving average and this key support area that I just mentioned between 4,239 and 4,187. Moving on to the Russell 2000. Now, we don't normally cover the Russell 2000, but I thought it would be interesting to look at it because basically this is the great underperformer with regards to the US equity indices, in that it is actually at the moment trading at minus 1% year to date. And we can see here that we've managed so far to hold above this key support area going back to December of last year and all the way to May of this year. 690. So that is a really key support area to look out for in case of non-farm payrolls coming in stronger than expected and the Russell 2000 setting off. Maybe that support area could then hold, but if the non-farm payrolls come in lower than expected, it is likely that we get some risk on sentiment, and that could then take us back up again towards the late September low at 1,762 for the Russell. But here you can also see we remain in a very clearly defined downtrend, and for this to change, what we need to see is a rise and daily chart close above the last, to say a high on the daily candle, which is higher than the one to its left and to its right. And this was made on Friday, the last Friday in September, and that was at 1,810. So this is the level that we need to overcome. And as you can see, it's quite a long way away before we can have a reversal to the upside with regards to the Russell 2000. The US dollar remains very much on track for having yet another weekly positive close, even though it started to top out at the beginning of, well, in the middle of this week. And we may still, though, see a 12th consecutive week of rising prices for the US dollar basket. If I zoom out onto a weekly chart, you can see here that we've had these 12 weeks in a row. At the moment, for this to happen, financial day, we would have to close today on Friday, the last day of the week, above 106.49. But it is still a possibility. It will really depend on what the non-farm payrolls data will say later on today. But you can see here, we have started to come off our previous high made on Tuesday at 106.97, which was the high last traded back in, I believe it was November of last year. And what is interesting from a technical perspective here is that that latest high on the chart has not been confirmed by a higher reading of the relative strength index, the RSI. This is showing you a lower high. And when that happens, that is called negative divergence, and it points to at least a short-term correction in the overall trend, in this case the uptrend, meaning that we could now see a sideways to downward trend, which is what happened over the last few days. But it can sometimes mean the beginning of a major reversal to the downside, and I'll show you that on the oil price later on. But here, that would happen if we were to fall through the last reaction low, that is to say the low at the end of September at 105.29. If we were to fall through 105.29, not only would we be falling out of this upward trending channel we've been in since July of this year, but we would also be confirming a top formation, at least a short-term top, in which case the US dollar basket could very quickly come back down to the May high at 104.26 and even lower. But let's just see what's going to happen with regards to the dollar basket later on today with regards to the non-farm payrolls data. And the inverse of the US dollar basket, the euro making up 57.6% of the euro dollar basket, is the euro dollar exchange rate. And we can see here that we are so far on track for our third consecutive day of gains, having bounced off the 104.60 level on this daily financial bet. And that is right within this key support area I've been mentioning for over a month now, between 104.84 and 104.44, where we actually are at the moment bouncing back from. So depending on what the non-farm payrolls data will be out of the US from today, back up to the September high at 106.17. This is the last reaction high. And if we were to manage to close above that, then a reversal to the upside could be seen here. And here we have positive divergence on this chart. Can you see here that low that was made this week on the relative strength index is actually a higher low than the one that was made at the end of September. So that is called positive divergence. And it means there is a very high probability of around 70% that a reversal, at least a short-term reversal in the overall downtrend, is likely to be seen. Now, as I said, the line in the sand here is basically 106.17, the high seen at the end of September. If we rally above there, close above there, we could see this reversal taking shape and perhaps rise all the way back up again towards the red line here, the 200-day simply moving average at 108.26. But unless that happens, the downtrend is still intact and the trend is your friend. So just be aware of that. With regards to the euro against the British pound, what we're seeing here is that the British pound is once again strengthening very slightly. We are now at the moment falling through the September to October uptrend line. And if we were to fall through last week's low, the late September low at 86.31, then a top could be formed here and we could reintegrate the middle of this sideways trading range we've been in since June of this year. And nothing will change with regards to this bearish short-term momentum unless we were to take out the current October high at 86.91 here, the last reaction high, in which case we could retest the 200-day simple moving average and also the high seen back in July and also in September of this year between 87.01 and 06. But right now it is pointing lower with regards to euro sterling. And last but not least, the British pound against the US sterling, the British pound against the US dollar, I should say, is also bouncing off support. You can see here it's bouncing off the lower boundary of its downtrend channel at 120.38. and is heading towards the last reaction high, that is to say the late September high at So with regards to commodities, the rapidly rising US dollar over the last 11 consecutive weeks, with perhaps today, Friday, we are seeing the 12th consecutive week of rising US dollar. Sorry, I should be saying commodity markets have come off. You can see that with regards to the oil price. Now here, the reason was really demand. We had far less demand with regards to the latest EIA data, and basically this has led to a very sharp sell-off with regards to the oil price after this week's OPEC Plus meeting, as no further OPEC Plus cuts were announced. And you can see here what was interesting is that we've been warning since the end of September, because of that negative divergence we saw on the price of WTI, that a reversal to the downside could be happening, especially if we were to fall through the late September low at $87.85, which is exactly what has happened. And you can see here we've had a very sharp decline, not just take us down to our first downside target to the August high at $84.39, but so far to $81.21. So because of this reversal and it being so sharp and quick, the next downside targets really are likely to be hit. And these are the late August low at $77.60, and here in red, the 200-day simple moving average at $77.43. So this is what is in store for the oil price, provided we stay below the orange line here, the 55-day simple moving average at $84.21. And oil is not the only commodity which has come off because of, in part, the strong US dollar. You can see the gold price has also declined very sharply over the last few weeks. This also, of course, had to do with the rising US yield. In the US, for example, we had the 30-year yield, the bond yield, rise to 5.01% this week, and the 2-year yield rising to a new all-time high. And that basically has meant that some people prefer to hold bonds nowadays instead of investing into gold, and that led to the very sharp decline in the gold price. But we are at the moment basically hovering above this key support area I've also been mentioning over the last few days, between $1,810 and $1,805 per troy ounce, which were made back in February and March of this year. And we'll have to see whether the non-farm payroll data today might give us some respite, and if we could perhaps rally back towards the 1,850 area. But you can see here the volatility has really come out of the gold price at the moment. And when we look at silver, the decline has also been quite sharp in that we've fallen through this key support area made up of the June to September lows between $22.30 and $22.12, and dropped all the way down to $20.69. And around there, we've basically been sideways trading. So again, if that would to give way, the next downside target would be the psychological $20 mark, together with the March low at $19.90. But if we were to manage to recover, then we've got this huge resistance area to look forward to, and that is likely to cap the silver price going forward. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle, actually, I should say, sorry, X. My X handle, formerly known as Twitter, is Axel. It's at Axel R_IG. Have a lovely weekend.